Is this the right time to buy gold? That's a question on everyone's mind right now. Gold just crossed 1.25 lakhs per 10 grams in India, and suddenly everyone wants to talk about it again. But here's what's crazy. Every single time gold hits a new high, two camps emerge. One group says, "See, I told you gold will always go up, buy now." And the other warns, "No way, this is the top, it's going to crash any moment." So who's right? And more importantly, are you too late to the party? Because here's the truth most people won't tell you. In 2025 alone, gold has already surged by more than 56% year over year. That's not a typo, 56%, and it's not just gold, silver is surging too, following a similar explosive pattern. The precious metals market is on fire right now. Think about it, back in April this year, 10 grams of gold was only lakh rupees. Today, it's trading at nearly 1,26,000. That's a jump of over 26,000 in just 6 months. So the real question isn't just, should I buy gold? It's what's happening in the world that's making gold explode like this, and is it going to keep going? By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is FinNiki, where I simplify money the same way I practice it. And today, I'm going to break down exactly why gold is rallying, whether you should invest now, and the smartest way to do it without falling into the FOMO trap. Let's dive in. Alright, first things first, why is gold going absolutely crazy right now? Let me paint a picture for you. Imagine you're at a party and suddenly someone yells fire. What happens? Everyone panics and rushes towards the exit, right? That's exactly what's happening in global markets right now. Except the exit that everyone's running towards is gold. There are 3 major factors pushing gold prices through the roof. And trust me, once you understand these, everything will click. Number 1, global fear and uncertainty. Every time the world looks scary, people run to gold like it's their financial safety blanket. Think about what's been happening. The Russia-Ukraine war, that just won't end, ongoing tensions exploding in the Middle East, and the whispers of an economic slowdown in the US. When investors see this chaos, they stop trusting paper currencies, they panic about stocks crashing, and they turn to one thing that held value for thousands of years: gold. Here's a way to think about it. Stocks can drop 20% overnight, crypto can lose half its value in a week, but gold, it's that reliable friend who's always there when everything else falls apart. 2, central banks are holding gold like never before. Now, this part is really wild. In 2023 alone, central banks across the world purchased over 1,000 tons of gold. That's one of the biggest buying sprees we have seen in decades. Countries like China, Turkey, and even India are stockpiling gold in their reserves. Why? Because they are trying to reduce their dependency on US dollar. They're basically saying, we trust gold more than we trust paper money. And here's the kicker, when big players, central bank, governments, huge institutions start buying something aggressively, the price automatically shoots up. It's basic economics, high demand, limited supply, price skyrockets. 3, low real returns everywhere else. This one's simple but powerful. Gold doesn't give you interest or dividends, right? So why would anyone choose gold over a fixed deposit? Here's why. Let's say your bank's fixed deposit gives you around 7% interest. Sounds good, but wait, inflation is running at 6%. So your real gain, the money you actually get to keep after accounting for the rising prices, is just 1%. Meanwhile, gold has been protecting purchasing power way better. When inflation rises, gold usually rises too. And here's something interesting. Silver is experiencing a similar surge. Investors rushing to both gold and silver as safe havens, driving up prices across the precious metals board. So to sum it up, people are scared, inflation is biting hard, and the world's biggest institutions are holding gold like it's going out of style. These 3 forces combined have turned gold into the star performer of 2025. Now, before we figure out if you are too late to invest, let's zoom out and look at the bigger picture. Because gold has a very clear pattern, and that pattern is simple: gold loves chaos. Let me take you back to 2008. Remember the global financial crisis? Banks were collapsing left, right, and center. Stock markets were in free fall. Millions of people lost their jobs. It was financial Armageddon. But guess what happened to gold? It didn't crash, it exploded. In the next 3 years after 2008, gold prices nearly doubled. Why? Because when everything else felt like quicksand, gold felt like solid ground. Fast forward to 2020, COVID-19 hits, factories shut down, global trade freezes, stock markets swing like roller coaster on steroids, and once again gold hit record highs. The theory is simple: when everything else feels risky, gold feels safe. It's that one asset that never lets you down when the world is falling apart. But, and this is a big but, gold doesn't rise forever. Here's the catch most people ignore. Once a crisis fades and confidence returns, investors slowly move their money back into stocks, mutual funds, businesses, basically assets that can grow faster than gold. Perfect example, after gold hit its all-time high around 33,000 per 10 grams in November 2012, global markets started stabilizing, and what happened? Gold fell nearly 30% over the next few years. So if you're sitting there thinking gold prices will keep rising forever, history is tapping on the shoulder saying, hold on my friend, gold is cyclical, it rises when fear dominates. It cools down when optimism returns. Hey, quick pause. If you're finding this useful so far, just hit the like button and subscribe. It's a small thing, but it really helps me know that you're actually enjoying this kind of content and keeps me motivated to make more of this content for you. Okay, now let's address the 1 lakh per 10 gram question that's probably burning in your mind too. Is it too late to buy gold now? The answer isn't a simple yes or no, and here's why. See, gold isn't some multi-bagger stock that's going to give you 10x return overnight. It's not designed for that. Thinking of gold like this, it is not the flashy sports car that zooms ahead. It's the seatbelt that keeps you safe when the car crashes. Let me give you an analogy. When you buy health insurance, do you expect profit from it? No, right? So you buy it for protection. Gold works exactly the same way for your money. It does not make you rich, it keeps you from getting poor when things go wrong. Now, I know what you're thinking, but Nikhil, prices have already shot up so much. If I buy now, won't I lose money? Look, if you're buying gold expecting it to double in the next year, you might end up disappointed. But if you're buying it as a long-term store of value, to safeguard your wealth against inflation, market crashes, or currency fluctuation, then it absolutely will make sense to own some. Here's a brutal truth. No one can time gold perfectly. Not you, not me, not even the so-called experts on TV. Instead of trying to catch the lowest price like you're trying to catch a falling knife, focus on building your allocation gradually. That means monthly investment in digital gold, gold ETFs, or sovereign gold bonds. That way, you're not betting on gold for quick gains. You are building stability into your portfolio. That's why experts recommend holding 5 to 10% of your portfolio in gold. Not more, not less. It's the sweet spot. So the bottom line is, it's not too late to buy gold now, but it's also not a rush and buy everything situation. Alright, so by now you're probably thinking, okay Nikhil, I get it, I should own some gold, but how should I buy it? Great question, because gone are those days when buying gold meant walking into a jewelry shop, bargaining with the uncle behind the counter, and walking out with a chain or a coin. Also, buying jewelry also comes with a whole lot of circles with it. GST, skyrocketing, making charges, purity concerns, storage headaches, the list goes on. So buying jewelry as an investment, not the smartest move. Today, you can own gold digitally, safely and smartly without worrying about lockers or fake gold. Let me walk you through the realistic modern way to invest in gold. Option number 1, gold ETFs, my personal favorite. This is how modern investors, especially younger professionals, prefer to buy gold. Here's how it works. Open your investment app and search for gold ETF. You'll see names like Nippon India Gold ETF, HDFC Gold ETF, or SBI Gold ETF. Not a promotion of any of these fund houses. I'm just giving you certain example. You can choose whatever is best for you. You can buy units of these just like you buy shares. No locker, no making charges, no purity worries. And if you ever need money, you can sell them instantly and get cash in your bank account. If you don't have a Demat account, no problem, go for gold mutual funds like Kotak Gold Fund or an Axis Gold Fund. They invest in the same ETFs, so you get the same returns but with the simplicity of SIPs. This is personally one of the easiest way to get exposure to gold without turning into your family's jewelry accountant. Option 2, digital gold, perfect for small investments. This is the latest trend and it's perfect for people who want to start small. You can buy gold even worth 100 rupees on apps like PhonePe, Paytm, Tanish Digital, or even Google Pay. The platform automatically buys the quantity of gold and stores it securely in a vault for you. It's perfect if you want to build gold gradually, say 500 or 1000 every month. You don't even need to think twice. But here's the catch, digital gold isn't regulated yet by SEBI or RBI. So while it's fine for small investments, don't dump your entire life savings there. Keep it for casual monthly gold buying. Option 3, physical gold, the emotional one. Let's be real, every Indian household has some gold lying around somewhere. Your mom probably has that family necklace that only comes out during weddings, or coins brought out on Dhanteras that hasn't been even touched in years. Gold jewelry has sentimental value, absolutely, but financially, it's not a smartest investment. Here's why. Even if gold prices rise 15%, your actual profit might be just 7 to 8%. Why? Because you lose around 8 to 10% in making charges, GST and purity concerns. So if you must buy physical gold, go for coins and bars and not jewelry, and must buy BI's hallmark gold. Think of it as owning a gold for peace of mind, not profit. Option 4, gold SIPs, the modern twist. Yes, just like mutual funds have SIPs, brands like Tanishq, Malabar Gold and CaratLane offer monthly gold savings plan. You can start with as little as 1000 rupees a month, and over 10 to 12 months, your money accumulates as gold at prevailing prices. At the end of the year, you can either buy jewelry with that gold or continue investing. It's a great option for those who love gold but don't want to spend big in one go, or for those who want to gift themselves a gold piece without feeling the pinch. Here's a bonus. Some smart investors also like to diversify with silver, and honestly, this is getting more interesting by the day. Silver has been surging alongside gold, and for good reasons. Unlike gold, which is mostly seen as a store of value, silver has massive industrial uses: batteries, solar panels, electronics, electric vehicles. As the world moves towards renewable energy and tech, demand for silver is exploding. Plus, silver is more affordable. You can start with smaller amounts, and it sometimes moves more aggressively than gold, giving you potential for higher returns, though with higher volatility too. Here's the thing. When gold rises due to economic fear, silver often follows. But when industry booms, silver can actually outperform gold because of its high industrial demand. So if you want diversification within precious metals, adding silver to your portfolio alongside gold is a smart move. You can definitely go for a mixed diversified metal investment portfolio. Now, here's something fascinating that's happening in the silver market right now. If you're watching silver closely, you might have noticed something unusual. A rare arbitrage opportunity has appeared in 2025. What's happening is that silver prices across different markets, physical market, ETFs and MCX futures, have drifted way out of sync. And some experienced traders are actually making quick profits from these price gaps. Let me break this down simply. Imagine you walk into 3 different shops and the same product is priced completely differently in each one. That's what's happening with silver right now. Physical silver in India trades at a premium due to short supply and festive demands, sometimes 10 to 12% higher than MCX or ETF prices. Silver ETFs are designed to mirror physical silver prices, but when demand surges, their prices can shoot far above their actual underlying NAV. MCX futures might lag behind both ETFs and physical prices, giving you chance to buy low in one market and sell higher in the other. So if you're clever, you can actually exploit these gaps, and this is important. This is for experienced traders only, not for beginners. So how does the arbitrage work? Let me walk you through this step by step. Step 1, spot the opportunity. You need to monitor prices daily across major bullion sites, ETF portals and MCX. Look for price gaps that are greater than your transactional cost and taxes. For example, physical silver is currently trading at 1.8 lakhs per kg, while MCX futures are at about 1.5 lakhs. That's a 30,000 gap per kilogram. Step 2, execute the arbitrage. You have 2 main options here. Option A, physical versus MCX. Sell your physical silver at premium price, say to a jeweler or a dealer at 1.8 lakhs per kg. Simultaneously buy the equivalent quantity of MCX futures to lock in your replacement cost. At MCX contract expiry, take delivery of silver. Your profit is the price gap minus logistics, taxes and commissions. Option B, ETFs versus MCX futures. If the ETFs units are trading at a premium, sell your ETFs units to lock in profits. Hedge by buying MCX futures or physical silver if you want to stay market neutral. Reverse positions when premiums shrink back to normal. That's substantial, but here's the catch. MCX physical delivery requires KYC, tax registration and regional compliance. It's not so simple paperwork, so maybe you may want to close the position before expiry and buy physical silver back. ETF transactions may face liquidity. Sudden price reversals or normalization of imports can completely erase your arbitrage profits overnight. So, Should you try silver arbitrage? Let me brutally be honest here. This is not for beginners. It's a strategy for experienced traders who understand futures market inside out. People familiar with ETFs mechanics and delivery procedures, those who can handle market volatility without panicking. Traders who have the capital and infrastructure for compliance. If you are just starting your investment journey right now, stick to simple silver ETFs or digital silver. Don't jump into arbitrage. It looks attractive, but the logistics and compliance hurdles can be overwhelming. So if you ask me what I personally prefer, I like to keep things balanced. I would buy gold ETFs like Nippon or HDFC gold ETFs for convenience and keep a small bit of physical gold, but as a coin and not as jewelry. Because let's face it, Indian households and emotions are inseparable. So that's the formula that works for me, practically, digitally, and emotionally satisfying. Now, let's look at what the experts are predicting, because this will help you make smarter decisions. According to the World Gold Council, demand from central banks and retail investors is expected to remain strong. But, and this is important, short-term price corrections are possible if the US Federal Reserve starts cutting rates in 2025. Why? Because lower interest rates might stabilize global growth, making equities attractive again. When that happens, some money will flow out of gold and back into the stock market. So while the long-term outlook for gold remains positive, short-term investors should expect volatility. Don't panic if you see a 5 to 10% or even 20% drop. That's just gold being gold. And by the way, the same trend applies to silver too. Silver prices are also expected to remain strong, especially with growing demand from renewable energy and electric vehicles industry. But like gold, silver can be volatile in the short term. Also, there's something specific to India. Gold prices here also depends heavily on rupee-dollar exchange rate. If the rupee weakens against dollar, gold gets costlier in India even if international prices stay flat. That's why Indian investors often see higher gold prices even when global markets cool off. The same dynamics affect silver prices too. Keep that in mind. Now let's talk about something uniquely Indian. There's a fascinating report by Morgan Stanley released in October 2025, and the numbers are mind-blowing. Indian households collectively hold about 34,000 tons of gold valued at approximately $3.8 trillion. That's nearly 88% of India's entire GDP. Let that sink in. This vast gold wealth is more than 3 times the value of current equity holdings by Indian households, which is about 1.18 trillion. What does this tell you? Indian households don't just buy gold, we worship it. We don't see it as an investment, we see it as an emotion, culture, tradition, and prestige. It's passed down through generations. It's bought for every major event, weddings, births, and even festivals. But here's the thing, the smarter way today is to keep emotions aside and think financially. Jewelry gold gives emotional satisfaction, but financial gold builds long-term stability. So, strike a balance between both. Keep some jewelry for tradition and sentiment, but for the wealth building, go digital and smart. Alright, so let's just wrap this up. Should you buy gold right now? Here's the clear answer. Yes, if you're buying gold for portfolio diversification, long-term protection, or to hedge against inflation and market volatility. And no, if you're expecting gold to double in a year, or if you're planning to replace all your mutual funds with gold. Buy smart, buy gradually, and buy for the right reasons. Because gold is not a ticket to richness, it's your seatbelt in a volatile financial journey. So, do you think gold will keep shining, or is this the peak? Tell me your views in the comments below. That's it from me. I'm Nikhil Verghese. Share this video and subscribe below to learn how to make your finances less tricky with FinNiki.